If you want to understand what is really happening behind the scenes of global power, if you want to see beyond superficial headlines and discover why Bitcoin causes so much discomfort among governments around the world, then you need to watch this video until the end. Because the debate about Bitcoin is not just about investment, it is not just about technology, and it is definitely not just about speculation. It is about power, about sovereignty, about who controls money and, consequently, who controls the rules of the game. And if you want to keep receiving deep analyses like this, subscribe to the channel now, because here we do not talk about shallow narratives, we talk about strategy. When Bitcoin was introduced to the world in 2008 by Satoshi Nakamoto, the international financial system was going through a structural collapse. The breakdown of the U.S. housing market triggered a systemic crisis that led to the bankruptcy of century-old institutions such as Lehman Brothers and forced governments to intervene massively to prevent a global domino effect. Central banks, especially the Federal Reserve, launched aggressive monetary expansion programs, cutting interest rates to near zero and injecting trillions of dollars into the economy through asset purchases. The public watched billion-dollar bailouts being financed, directly or indirectly, by expanding the monetary base, while millions were losing their jobs and homes. The perception that the system was structurally dependent on state intervention eroded trust in financial institutions and raised serious questions about the sustainability of a model built on growing debt and continuous currency issuance. In this context, the Bitcoin white paper did not emerge as a simple technological innovation, but as an alternative conceptual proposal to the existing monetary arrangement. It described a peer-to-peer payment system that eliminated the need for intermediaries and replaced institutional trust with cryptographic verification. The most disruptive aspect was not merely enabling decentralized digital transactions, but establishing a fixed and predictable monetary policy, with programmed issuance and a maximum limit of 21 million units. Unlike fiat currencies, whose supply can be expanded according to political decisions and fiscal needs, Bitcoin introduced the concept of absolute digital scarcity. For the first time, a digital asset possessed characteristics similar to those of a finite resource, yet operating on a global and open network, with no central authority capable of unilaterally altering its fundamental rules. For enthusiasts, this architecture represented financial freedom and protection against inflation resulting from expansionary policies. It was the promise of a system immune to bank bailouts, monetary manipulation, and discretionary government decisions. For states, however, the implication was more sensitive. The monopoly over monetary issuance is one of the pillars of sovereign power, as it allows governments to conduct economic policy, finance deficits, and influence growth cycles. A widely adopted asset operating outside this control introduces an unprecedented element of monetary competition in the modern era. Bitcoin, therefore, was not merely a new financial instrument. It represented the concrete possibility of a parallel system capable of coexisting and potentially competing with national currencies, challenging the centrality of the state in defining the rules of money. To understand the reaction of states to Bitcoin, it is essential to recognize that money is not merely a medium of exchange, but a central instrument of public policy and macroeconomic management. Central banks, such as the Federal Reserve or the Banco Central do Brasil, use tools such as setting interest rates, conducting open market operations, and controlling the monetary base to influence inflation, credit, consumption, and investment. In times of recession, monetary expansion can stimulate economic activity. During periods of overheating, contraction helps contain inflationary pressures. Furthermore, the ability to issue currency allows governments to finance deficits, sustain social programs, and respond quickly to unexpected shocks such as wars, financial crises, or pandemics. This flexibility constitutes one of the pillars of modern sovereignty, as it gives the state room to maneuver in adverse scenarios. Bitcoin breaks with this logic by introducing a monetary policy that is immutable and predetermined by code. Its supply cannot be adjusted according to economic conditions, nor expanded to finance public spending or stabilize markets. It does not respond to political cycles or electoral pressures. This absolute predictability, seen by its supporters as protection against inflation and fiscal irresponsibility, is interpreted by many governments as a severe strategic limitation. Without the possibility of additional issuance, there is no way to use the asset as a countercyclical tool or as a mechanism for managing public debt. In a hypothetical scenario of widespread adoption, this would significantly reduce the effectiveness of traditional monetary policy instruments, altering the balance between state and market in the conduct of the economy. The case of El Salvador exemplifies a response that transforms this limitation into a strategic opportunity. Under the leadership of Nayib Bukele, the country adopted Bitcoin as legal tender in 2021, becoming a pioneer in this movement. The decision was received cautiously by institutions such as the International Monetary Fund, which warned about risks related to volatility and financial stability. However, from a domestic perspective, the adoption represented an attempt at geo-economic repositioning. Since 2001, El Salvador has been a dollarized economy, dependent on the US dollar and, consequently, on the decisions of the Federal Reserve, without any participation in the decision-making process. By incorporating Bitcoin into its monetary system, the government signaled a willingness to reduce external dependence and explore alternatives to the traditional arrangement. Beyond the symbolic and geopolitical dimension, there were practical motivations. A significant portion of El Salvador's GDP comes from remittances sent by citizens living abroad, especially in the United States. These transfers, traditionally intermediated by financial companies, involve substantial fees that reduce the amount effectively received by families. The government presented Bitcoin as a solution to lower costs and speed up this flow, promoting financial inclusion and greater efficiency. At the same time, it sought to attract foreign investment and consolidate the country's image as a hub of technological innovation. Thus, the adoption was not merely an ideological gesture, but a multifaceted strategy combining limited monetary sovereignty, the search for global differentiation, and an attempt at economic modernization in a competitive international environment. El Salvador's adoption of Bitcoin quickly moved beyond the economic sphere and entered the realm of geopolitics. By officially recognizing a decentralized currency, the country symbolically challenged the international financial architecture based on fiat currencies issued by sovereign states and intermediated by multilateral institutions. In a system where access to credit, debt renegotiation, and exchange rate stability often depend on organizations such as the International Monetary Fund, the Salvadoran decision sounded like a move toward asserting autonomy. It was not merely about adopting a technology, but about signaling that a country could seek alternatives outside the traditional axis of global monetary governance. The concern expressed by international institutions was not limited to the asset's volatility. The sensitive point was the precedent. If emerging economies began incorporating decentralized assets as a structural part of their monetary systems, the model based on national currencies controlled by central banks could gradually erode. The influence exercised through international credit, conditionalities, and financial agreements could be reduced if countries found alternative means of raising capital and settling transactions. In this sense, El Salvador began to be observed as a real-time experiment, a laboratory testing the political and economic viability of a hybrid arrangement between state sovereignty and decentralized currency. At the same time, the movement carried a strong symbolic component. A small country, historically dependent on external flows and decisions made in global financial centers, assumed a leading role in a debate dominated by major powers. The strategy projected El Salvador as a hub of innovation and attracted international attention disproportionate to its economic size. This strategic repositioning sought not only financial gains but also political and technological relevance, reinforcing the idea that monetary competition in the 21st century is not restricted to disputes among large economies, but can also include peripheral actors willing to take calculated risks. In direct contrast, China adopted the opposite approach, marked by severe restrictions on cryptocurrency mining and transactions. Although official justifications emphasized financial risks and investor protection, the central strategic dimension lies in capital control. China maintains a carefully structured system to monitor and regulate financial flows, preserving exchange rate stability and preventing abrupt capital outflows that could pressure its economy. Bitcoin, by enabling censorship-resistant international transfers outside the traditional banking system, represents a direct threat to this model. In an environment where the state exercises deep supervision over the financial sector and uses this oversight as a tool of economic policy, the existence of a decentralized and autonomous network is not merely inconvenient, it is structurally incompatible with the logic of control that underpins China's economic strategy. By developing the digital yuan, known as ECNY, China made it clear that its resistance to Bitcoin was not opposition to technology, but to the loss of control. The ECNY is a digital currency issued by the People's Bank of China and is part of the country's national financial modernization strategy. Unlike decentralized cryptocurrencies, it operates within a hierarchical architecture in which the central bank maintains full authority over issuance, settlement, and supervision. The digitalization of the yuan enables instant payments, integration with technological platforms, and greater efficiency within the domestic system, while preserving the central logic of state command. Traceability is one of the pillars of this model. Each unit of the ECNY can be monitored, expanding the government's ability to combat tax evasion, money laundering, and corruption, while simultaneously reinforcing oversight over economic flows. In a country that already possesses robust digital surveillance infrastructure and integration between financial data and civil identity, the digital currency strengthens economic governance. This approach reveals the central contrast between CBDCs and Bitcoin. While Bitcoin distributes power across the network and limits political intervention, China's digital currency concentrates power in the state, expanding its capacity for macroeconomic management and microeconomic monitoring. This clash is not merely technological, but philosophical. Bitcoin was conceived as a neutral system, resistant to censorship and independent of any central authority. CBDCs, on the other hand, represent the digitalization of traditional sovereign money. They offer speed, efficiency, and integration with digital economies, but without relinquishing the state's monopoly over currency. China signals that it is willing to lead the next phase of global financial innovation, provided that this leadership aligns with the strategic interests of the party and the preservation of monetary sovereignty. The message is clear. Modernization does not mean decentralization. In the United States, the response was more pragmatic and gradual. As the issuer of the world's primary reserve currency, the country occupies a unique position in the international financial architecture. The dollar underpins global trade, foreign exchange reserves, and foreign policy instruments such as economic sanctions. A widely adopted decentralized asset could, in theory, reduce the centrality of the American financial system and limit the effectiveness of these geopolitical tools. Still, the United States chose to integrate Bitcoin into a regulated environment rather than ban it. The approval of spot Bitcoin ETFs by the U.S. Securities and Exchange Commission marked a decisive moment, allowing large investors to access the asset through supervised structures. This strategy combines recognition of Bitcoin's relevance with the preservation of institutional oversight, maintaining financial leadership while incorporating innovation into the existing system. The integration of Bitcoin into the United States financial system does not represent unrestricted acceptance, but rather a carefully structured process of regulatory framing. Exchanges operating in the country are required to comply with strict Know Your Customer (KYC) rules, anti-money laundering (AML) policies, and periodic reporting to tax authorities. Agencies such as the U.S. Securities and Exchange Commission and the Financial Crimes Enforcement Network work to ensure that the trading and custody of crypto assets occur within legal parameters already applicable to the traditional financial system. The logic is clear. If Bitcoin cannot be eliminated, it must be absorbed under institutional supervision. This move also serves a broader strategic objective. By allowing major financial institutions to offer regulated products linked to Bitcoin, such as ETFs and structured funds, the United States keeps innovation within its own jurisdiction. This prevents capital, talent, and companies from migrating to more permissive regulatory environments, preserving the competitiveness of the American financial market. Rather than adopting a prohibitive stance that could push activity into the shadows or into other countries, the government chose to tax, monitor, and integrate. This approach reinforces the global leadership of the dollar while acknowledging the growing relevance of digital assets. Behind these strategies, whether American regulated integration, Chinese restriction, or Salvadoran adoption, lies a common denominator: concern over monetary sovereignty. Control over currency is a central element of modern state power, as it enables influence over inflation, credit, employment, and economic growth. Central banks use monetary policy as a tool to smooth economic cycles, respond to crises, and sustain public policies. When a significant portion of the wealth of individuals and companies migrates to an asset outside the sphere of state issuance, the capacity for macroeconomic management can be reduced. Monetary policy depends, to a large extent, on the centrality of the national currency in economic life. In addition, there are fiscal and structural implications. If transactions occur on decentralized networks without integration into the traditional banking system, tax collection may become more complex. Although the blockchain is transparent, the association between digital addresses and civil identities depends on regulatory mechanisms. Governments fear that the expansion of parallel systems could weaken their tax base and limit the effectiveness of tools such as capital controls or economic sanctions. Ultimately, the debate is not merely about financial technology, but about who holds final authority over money, the circulation of wealth, and the mechanisms of power that sustain the contemporary state. Traceability is one of the most misunderstood points in the debate about Bitcoin. Unlike physical cash, whose transactions are virtually impossible to audit after circulation, the Bitcoin network is a public and permanent ledger. Every transaction is immutably recorded on the blockchain, accessible to anyone with the appropriate tools. Companies specialized in on-chain analysis can map patterns, identify connections between wallets, and reconstruct financial flows with increasing levels of sophistication. What exists is not absolute anonymity, but pseudonymity, alphanumeric addresses that do not, by themselves, carry an associated civil identity. The connection between identity and wallet typically occurs at the system's entry and exit points, such as exchanges and regulated financial institutions. It is precisely at this point that a duality emerges for governments. On one hand, if exchanges and intermediaries are required to comply with strict identification and reporting rules, Bitcoin can become even more traceable than physical cash or traditional tax havens. On the other hand, if individuals operate exclusively in decentralized environments, using private wallets and peer-to-peer platforms, supervision becomes more complex. The effectiveness of oversight depends on cooperation between jurisdictions, data sharing, and integration between the traditional financial system and digital infrastructure. Thus, Bitcoin can function either as a tool for transparency or as a vector for evasion, depending on the regulatory framework applied. The geopolitical dimension further expands this equation. Countries subjected to international sanctions may turn to digital assets to reduce their dependence on banking systems dominated by major powers. The global payment system, heavily influenced by the dollar and Western financial institutions, is often used as an instrument of diplomatic pressure. If international transactions can be settled through decentralized networks, part of that coercive power weakens. At the same time, economies with a history of high inflation or currency instability see Bitcoin as an alternative store of value, capable of preserving purchasing power beyond the reach of volatile domestic policies. Thus, the perception of Bitcoin as a threat or an opportunity varies according to each country's position within the global economic structure. In this context, the dispute between CBDCs and decentralized cryptocurrencies goes beyond technological innovation and enters the realm of monetary governance. Central bank digital currencies promise efficiency, financial inclusion, and integration with digital economies, but they preserve state control over issuance, traceability, and monetary policy. Bitcoin, in contrast, offers algorithmic neutrality, predictable supply, and resistance to censorship, eliminating classic instruments of economic intervention. Governments do not assess this choice solely from a technical perspective. They evaluate its impact on stability, tax collection, foreign policy, and crisis management capacity. At the center of this debate lies the essential question of who defines the rules of money in the 21st century: decentralized protocols or sovereign authorities. At the center of this entire discussion lies an invisible yet decisive element: trust. Fiat currencies function because entire societies trust that the state will maintain stability, control inflation within acceptable limits, and honor its obligations. This trust is not merely economic, it is institutional. It involves political credibility, regulatory predictability, and legal stability. Bitcoin, on the other hand, shifts that trust from institutions to the protocol. It does not depend on the reputation of a government, but on the cryptographic security of the network and the immutability of its code. It represents a profound transition, from trust in human authorities to trust in mathematical rules executed through distributed consensus. The existence of an alternative model creates an unprecedented form of monetary competition. Even if Bitcoin does not replace national currencies, it imposes indirect discipline on the traditional system. Central banks know that, in a connected world, individuals can transfer part of their wealth into an asset whose supply cannot be inflated by political decision. This pressures monetary authorities to maintain more transparent and responsible policies, under the risk of gradual loss of credibility. The mere existence of a functional alternative alters the dynamics of power. It is not just about financial markets, but about institutional balance. The most likely scenario for the coming decades is not the complete replacement of state-issued money, but a strategic coexistence. Governments will continue regulating the sector, developing their own digital currencies, and seeking to integrate innovation without relinquishing sovereignty. Bitcoin will continue operating as a borderless global network, attracting individuals, companies, and even states that wish to diversify reserves or reduce dependence on traditional systems. This coexistence will be marked by permanent tension. On one side, the state's interest in maintaining control and intervention capacity. On the other, the growing desire for financial autonomy and protection against macroeconomic risks. When governments analyze Bitcoin, they do not do so based on ideological sympathy. The assessment is pragmatic and strategic. They evaluate its impact on tax collection, the effectiveness of monetary policy, exchange rate stability, and geopolitical influence. Countries whose currencies hold a dominant position in global trade tend to protect the status quo. Peripheral nations may see an opportunity for repositioning. Some choose regulated integration, others impose severe restrictions, and others pursue controlled experimentation. What they all share is the awareness that ignoring the phenomenon is not a viable option. At the end of the day, the debate about Bitcoin is a debate about who defines the rules of money in the 21st century. It is about power, sovereignty, and the limits of state authority in a digital age. If you want to continue understanding the strategic forces shaping the future of the global economy, leave your like now and subscribe to the channel. Because here, we go beyond the surface and analyze what is truly happening behind the scenes of global financial power.